Hi, I'm Wayne Smith for 4D Finance, and this is Dividend Watch. We're going to talk about the Credit Suisse implosion and could you be at risk with your greater than 8% dividend stock and don't even know it. Credit Suisse is a humongous company that's being bought out, a large asset management company. It's being bought out by UBS, which is another large Swiss investment concern. Now, we're talking about risk. There are certain products that they have. They're exchange traded notes. And not to get into a whole lot on that, but they borrow money to do a strategy called a covered call strategy to bear income on their stock. What they do is from covered calls, they take the money that they make from doing the covered call and put it back into the actual stock investment pile of cash, so to speak, and you get paid out of that pile of cash. And typically they pay over 8%. At one time, I was in each of these stock that I'm going to tell you about, and I'll put up a graphic of who they are and what they are very quickly during this video as I discuss them. Now, we're talking about, are you at risk potentially, even though you may not look like you're at risk? Well, Credit Suisse is having a problem. And they have the Credit Suisse Gold Shares Covered Call ETN. That's GLDI. They have the Credit Suisse Silver Shares Covered Call ETN. SLV as in Victor. They have the Credit Suisse Crude Oil Shares Covered Call ETN. USOI. So that's GLDI, SLV, and USOI. And I was in all of them at one time. I'm no longer in them. I was actually, I exited my position, I think, first week of November, if I am correct. Now, is that financial advice? No, I'm just telling you what I did. I can't give you financial advice. All I can do is report what I think I see and give you my opinion on what I see. Credit Suisse investors could be facing losses of 100% or nearly that on investments in Credit Suisse. Okay. I mean, some people call it Credit Suisse, I'll go back and forth on those names. It's the same company. They've had a bunch of self-inflicted crises, and it's no longer a bank. It doesn't have that separate entity in and of itself right now. So if you bought the common stock, what you see on the stock ticker on Wall Street through your broker, you've seen that plummet very rapidly. It's been propped up. It seems like it's been propped up because it went to $4.22, and I thought last year it should have crashed. But that's my opinion. It's only my opinion. Well, they're going to write off $17.3 billion of outstanding bonds so they can increase their capital. Those bonds were owned by Pacific Investment Management Company and Invesco Limited, respected companies. And those retail products that I mentioned to you, GLDI, SLV, USOI, they're being affected by Credit Suisse's collapse. They can't not be affected. They are debt instruments. Money was borrowed to buy a stock that they have a part in, they have ownership of, and do a covered call strategy on it to put money back in to pay you as an investor. So they give you some exposure to those commodities, gold, silver, oil. I thought they paid phenomenal yields from their covered call strategy, and I profited off of them. SLVO, GLDI, USOI, I was in. I was happy with it until I couldn't find information on how Credit Suisse was doing as a company. And I looked for 2 months. And when I can't find something, I lost my confidence in it. Could I tell you to get out of it? No, I'm not a financial advisor. But I looked at the facts and I didn't like it then. It's become more apparent now. Let's go over this now. Maybe I should take a little time. An exchange traded note. It's unsecured debt. Okay? It's an unsecured debt obligation. And what they do with this, what their strategy is, to generate returns to match the investment strategy. Okay, so they're going to do a covered call strategy. In the market, that's a sell action. You buy a call and you sell a call at a higher rate. You take that premium, you dump it back into the stock at expiration as profit. Or you can early exit too. It's whatever is the best strategy, how to get out of it. And you put it back in and you make a profit and you return that profit to the investors, okay, in those. Now, unsecured debt obligation, that means that an issuer of an exchange traded note cannot pay it. They call that a default and pay little or nothing to investors. There's an interesting, how can I say, analogy. It's not really an analogy. It's a fact. It's actually an illustration we can use. Lehman Brothers, when it went bankrupt in 2008, September 2008, they had 3 exchange traded notes outstanding. Many investors sold the ETNs before Lehman collapsed. As a matter of fact, there was only $14.5 million in those notes that was left when it finally went under. Investors who didn't get out received pennies on the dollar. There was just no money there for them to get paid off of. The notes folded. Lehman didn't pay them. They were defaulted on. I don't know how else to say it. That's why Credit Suisse may expose you, if you're in those 3, to some risk. So that's it. Just something brief. Again, I say this is just my opinion. You probably heard me say it so much, you're probably sick of me saying it, but it has to be said. And I no longer hold those in my portfolio. All right. So for 4D Finance News, I'm Wayne Smith. This is a Dividend Watch, and I am out. Thank you.